Hello, UBC real estate students. Welcome to 55 UBC Practice Questions for Chapter 16 Mortgage Analysis in Real Estate Practice Prep Series. This set of questions is designed to help you solidify your understanding of key mortgage concepts, financing principles, and real estate investment strategies. Whether you're preparing for the exam or just looking to strengthen your knowledge, these practice questions will test your comprehension and improve your confidence. Take your time, think through each question, and let's get started.
Question 1. A purchaser has just agreed to a below-market vendor-supplied mortgage with a developer. The $384,000 mortgage is set at an interest rate of J2 equals 1.95%, with monthly payments over a 30-year amortization and a 3-year term. If the developer sells the 3-year term loan immediately to a mortgage investor for $350,000, what is the mortgage investor's yield, expressed as an effective annual rate, J1, rounded to 2 decimal places? The first step to solving this problem is to find the monthly payments and the outstanding balance owing at the end of the 3-year term. Step 1. Convert the nominal semi-annual rate, J2 equals 1.95% to monthly rate, J12. 1.95, shift, nom. 2. Shift, PYR. Shift, effective, calculator stores, J1 equals 1.959506%, effective annual. 12. Shift, PYR. Shift, nom, calculator displays, J12 equals 1.942125%. That is, the monthly nominal interest rate, J12 equals 1.942125%. Step 2. Calculate the monthly payment, PMT. 384,000, PV, loan amount. 360, N, 30 years, times, 12 months. 0, F, V, no remaining balance after 30 years. Press, PMT, calculator displays, PMT equals minus 1,408.25106, rounded to, minus 1,408.25. Step 3. Calculate outstanding balance after 3 years. Use the amort function. 384,000, PV. 1,408.25, plus and minus sign, PMT, to round off the payment. 36, input, shift, amort. Press, equal sign, 3 times. Calculator displays, 354,859.164285. Outstanding balance, F, V, equals 354,859.16, rounded. Step 4. Calculate investor's yield. The investor pays, PV, equals, 350,000. Receives, PMT, equals 1,408.25 monthly, for 36 months. Receives, a lump sum of F, V, equals 354,859.16, at the end of 36 months. To determine the investor's rate of return expressed as an annual rate, compounded annually, the calculator steps continue are as follows. 350,000 P, V. 140,825, PMT. 354,859.16, F, V. 36, N. Press, IYR, calculator displays, 5.256543. Shift, effective, to convert to the effective annual rate. J1, equals 5.385054%, rounded to 5.39%. The correct answer is D. 5.39%.
Question 2. A mortgage contract with a face value of $170,000 requires monthly payments of $1,117.12 over a 20-year period. However, the mortgage broker advances only $166,000 after deducting a commission of $2,500, legal fees of $1,000, and an appraisal fee of $500. Calculate the cost of funds advanced for the borrower, expressed as an effective annual rate, J1, rounded to 2 decimal places. Step 1. Understand the given information. Loan amount advanced to the borrower after deductions P166,000. Monthly payment PMT 1,107.12. Number of payments N 20 years times 12 months equals 240 months. Future value FV0. Loan fully amortized at the end. Compounding frequency monthly 12 PYR. Step 2. Solve for nominal monthly interest rate J12. Input into the financial calculator. 12 PYR. 166,000 PV. 17.12 plus and minus sign, and then press PMT 240N0 FV. Press IYR calculator display. IYR equal 5.234236%. Monthly nominal rate equals J12. Step 3. Convert J12 to effective annual rate J1. Press Shift Effective. Calculator display J1.36651%. Final answer D, 536%. Question 3. An offer of $235,000 is accepted, comprised of a cash down payment of $85,000 and a vendor-supplied mortgage loan of $150,000 at 5% per annum, compounded semi-annually. The loan has an amortization period of 25 years, a term of 5 years, and calls for monthly payments rounded up to the next higher dollar. Market rates of interest for equivalent mortgages are currently 8% per annum, compounded semi-annually. Calculate the market value of the mortgage, rounded to the nearest dollar. Step 1. Understand the given information. Offer accepted, $235,000 cash down payment, $85,000. Vendor supplied mortgage loan, $150,000. Contract interest rate, J2 equals 5%, compounded semi-annually. Loan amortization period, 25 years, N equals 25 times 12 equals 300 months. Loan term, 5 years, N term equals 5, times 12 equals 60 months. Market interest rate, J2 equals 8%, compounded semi-annually. Step 2. Convert contract rate to monthly rate. Contract nominal rate J2 equals 5%, 5. Shift to Shift PYR. Shift effective. Calculator displays J1 equals 5.0625%, 12 Shift PYR. Shift nom. Calculator displays J12 948,699%. Result. Monthly nominal contract rate J12 equals 4.948699%. Step 3. Calculate monthly payment. 150,000 PV100 NRO FV. Press PMT. Calculator displays 9872 at 40478, rounded up to 9873. Result. Monthly payment is $873. Step 4. Calculate outstanding balance after 5 years. Use the amort function to find the balance after 60 months. 150,000 PV, 873 plus and minus sign, and then press PMT. 60, input, shift, amort. Then press equal sign 3 times. Calculator displays 132 with 721 18365, rounded to 132 721.2. Result, outstanding balance at the end of 5 years is 132 721.02. Step 5. Convert market rate to monthly rate J2. Market nominal rate J2 equals 8%. 8. Shift nom2 shift PYR. Shift effective. Calculator displays J1 equals 8.16%. 12 shift PYR shift nom. Calculator displays 7.869836%. That is monthly nominal market rate. J12 equals 7.869836%. Step 6. Calculate market value of the mortgage. Press PV. Calculator displays 132,849,118,994. Market value of the mortgage, rounded to 132,849. The market value of the mortgage is A, $130,049. Question 4. A mortgage contract with a face value of $175,000 requires monthly payments of $1,103.21 over a 20-year amortization period. However, the mortgage broker advances only $171,000 after deducting a commission of $2,500, legal fees of $1,000, and an appraisal fee of $500. Calculate the cost of funds advanced for the borrower, expressed as an effective annual rate, J1, rounded to 2 decimal places. Step 1. Understand the given information. Face value of mortgage, $175,000. Amount advanced, $171,000 after $2,500 commission, $1,000 legal fees, and $500 appraisal fee are deducted. Monthly payment, PMT, $1,103.21. Loan amortization period, 20 years, N20 times 12 equals 240 months. Future value, FV, loan is fully amortized. Compounding frequency, monthly, 12 PYR. Step 2, solve for nominal monthly rate, J12. Input into the financial calculator. 12, shift PYR. 171,000 PV, amount advanced. 103.21 plus and minus sign, and then press PMT, monthly payment. 240N number of payments, 0 FV. Press IYR, calculator displays 4.7 monthly nominal rate J12. Step 3. Convert nominal monthly rate J12 to effective annual rate J1. Press Shift Effective. Calculator displays J1 equals 4.83428%. Result, the effective annual rate J1 is 4.83%, rounded to 2 decimal places. Final answer D, form 83%. Question 5. 3 years ago, Larry bought a house, at which time he arranged a mortgage for $240,000. The loan was written at a rate of 5.75% per annum, compounded semi-annually, calling for monthly payments of $500.05 and an outstanding balance of $214,038.44, due at the end of the 5-year term. Larry has just received an offer from Mary to buy his house. Mary's offer consists of $50,000 cash and assumption of the existing financing for the remainder of the term. If current lending rates for 2-year term mortgages are 8% per annum, compounded semi-annually, what is the market value of Mary's offer, rounded to the nearest dollar? Step 1. Understand the question. The market value of Mary's offer includes 1. The market value of the mortgage, calculated as the present value, PV, of the remaining 24 monthly payments of 15 FIs and the outstanding balance, FV, of $214,888.44, discounted at the market interest rate of 8% per annum, compounded semi-annually, the cash down payment of $50,000. Step 2. Convert the market interest rate, J2 equals 8%, to monthly rate J12. 8. Shift NOM, nominal semi-annual rate. 2. Shift PYR, compounding semi-annually. Shift Effective, calculator displays J1 8.16%, effective annual rate. 12. Shift PYR, monthly compounding. Shift calculator displays 7.869836%. That is J12 equals 7.869836%. Step 3. Calculate the present value of the mortgage. 24. N, remaining payments. 1,500.05 plus and minus sign, and press PMT, monthly payment. 214,838.44 plus and minus sign and press FV, outstanding balance at the end of the term. Press PV, calculator displays 260,855.29. This is market value of the mortgage. Step 4. Add the cash payment, Mary's cash payment, $50,000. Market value of offer equals market value of mortgage plus cash payment. Market value of offer equals 260,855.29 plus 50,000 equals 266,855.29. So the correct answer is B. Question 6. A developer is offering a mortgage loan of $102,000 at 5% per annum, compounded semi-annually on each of 16 units in a condominium development. The mortgages have monthly payments, 5-year terms, and 20-year amortization periods. Each unit is priced at $130,000, and the units have been selling over the past 7 months. Even with a recent decrease in interest rates, currently at J2 of 4%, the property has attracted the attention of a buyer who has made a full-price offer and applied for the developer's financing on one of the condominium units. Calculate the market value of the offer, rounded to the nearest dollar. Step 1. Calculate the original monthly payment, PMT. First, convert J2 equals 5% to J12.5, Shift NOM 2, Shift PYR. Shift Effective, calculator displays J1 equals 5.0625%, effective annual rate. 12. Shift PYR. Shift NOM, calculator displays J12 4.948699%. Now let's solve for payment, PMT. 102,000 PV, 240N, 20 years times 12 monthly payments, 0 FV. Press PMT calculator display, Magnus 670.267533. 67.27 plus and minus sign, and then press PMT to round off the payment. Step 2. Calculate the outstanding balance after 5 years. 60. Input, Shift, Amort, calculator displays per 60-60. Press equals sign 3 times, calculator displays 85,045.8242. Step 3. Calculate the market value of the mortgage. Use the outstanding balance, FV equals 85,045.8, and market interest rate, J2 is 4%, to find the market value of the mortgage, 8545.8 plus and minus sign, FV. Then we can calculate the PV based on market rates. The calculator steps continue as follows. Convert J2 equals 4% to J12. 4. Shift NOM. 2. Shift PYR. Shift Effective, calculator displays J1 equals 4.04%, effective annual rate. 12. Shift PYR. Shift NOM, calculator displays J12 equals 3.967068%. 60 N press PV, calculator displays 191.599675 market value of the mortgage, plus cash payment 28,000 equals 134,191.59975 market value of the offer. The market value of the offer, $134,192. The correct answer is A. Question 7. Bonafide Brokerage Ltd. arranges a mortgage with a face value of $55,000 for Gina Griffiths. Gina is obliged to make monthly payments at J2 equals 12% for 15 years to fully amortize the loan. The broker deducts legal costs of $450 and a brokerage fee of $1,500 from the face value of the mortgage. Calculate the monthly payment. Understand the problem. The monthly payment is based on the full face value of the mortgage, PV equals $55,000, and the stated terms. Legal costs and brokerage fees are irrelevant for this calculation. Convert the nominal interest rate, J2 equals 12%, to J12 12. Shift NOM2, Shift PYR, Shift calculator displays, J1 equals 12.36. 12 Shift PYR, Shift NOM, calculator displays, J12 equals 11.710553. Calculate monthly payment PMT. Input the loan terms into the calculator. PV equals 55,000. N equals 180, 15 years times 12 is 180. FV equals 0, fully amortized loan. Press PMT, calculator displays mega 649.89. So our payment is mega 649.89. Therefore, the correct answer is A. Question 8. Susan has offered to purchase a house from a vendor who is willing to provide partial financing. Susan's offer is a $75,000 down payment plus a mortgage of $125,000 at 4% per annum, compounded semi-annually. The loan is to be fully amortized with monthly payments over 20 years. If the market rate for similar mortgage loans is 6.5% per annum, compounded semi-annually, what is the market value of this offer? Rounded to the nearest dollar. Step 1. Understand the problem. The market value of Susan's offer consists of two parts. 1. Market value of the mortgage, present value of the payments based on the market interest rate. 2. Down payment, $75,000 given. Step 2. Calculate the monthly payment at the contract rate. Convert the contract rate, J2's 4%, to a monthly nominal rate, J12. 4. Shift, NOM. 2. Shift, PYR, shift effective. J1 equals 4.04% effective annual rate. 12. Shift, PYR. Shift, NOM. J1 equals 3.96768%. Calculate the monthly payment, PMT. PV equals 125,000. N equals 240. 20 years times 12 months equals 240 years. FV equals 0. Press PMT. Calculator displays minus 755.308081, 75.31, plus and minus sign, then press PMT to round off the payment. Step 3. Calculate the market value of the mortgage. Convert the market rate, J2 equals 6.5%, to a monthly nominal rate, J12. 6.5 Shift NOM, 2 Shift PYR. Shift effective, calculator stores J1 equals 6.60625%, effective annual rate. 12 Shift PYR, Shift NOM, calculator stores J12 6.413688%. Calculate the present value PV of the payments using the market rate. PMT equals minus 755.31, N equals 240, FV equals 0. Press PV equals 11999.94. Step 4, add the down payment. Market value of offer equals market value of mortgage plus down payment. Market value of offer equals 101,999.94 plus 75,000 equals 176,999.94 approx 177,000. Final answer D, 177,000 rounded to the nearest dollar. Question 9. An offer of $235,000 is accepted, comprised of a cash down payment of $55,000 and a vendor-supplied loan of $180,000 at 4% per annum, compounded semi-annually. The loan has an amortization period of 25 years, a term of 5 years, and calls for monthly payments rounded up to the next higher dollar. Market rates of interest for equivalent mortgages are currently 9% per annum, compounded semi-annually. What is the market value of the offer, rounded to the nearest dollar? Step 1. Loan information based on the contract rate. 1. Convert the contract rate, J2 4%, to monthly nominal rate, J12. 4. Shift NOM nominal input. 2. Shift PYR, payments per year semi-annual. Shift effective, calculator stores J1 4.04% effective annual rate. 12. Shift PYR, payments per year monthly. Shift NOM calculator displays 3.96768%. That is J12 3.96768%. 2. Calculate monthly payment PMT. 180,000 PV loan amount. 300 N total payments. 25 years times 12 months. 0 FV fully amortized loan. Press PMT calculator displays. NAIN is 946.83637. 947 plus and minus sign, and then press PMT to round off the payment. 3. Calculate the outstanding balance at the end of the 5-year term, FV. 60. Input, Shift, Amort, calculator displays, per 6060. Press equal sign 3 times. Calculator displays 156,686,286.21 plus and minus sign, and then FV to round off the future value. Step 2. Market value of the mortgage at the market rate. 1. Convert market rate, J2 equals 9%, to monthly nominal rate, J12. 9. Shift NOM nominal input. 2. Shift PYR, payments per year, semi-annual. Shift effective calculator displays 9.2025% effective annual rate. 12. Shift PYR payments per year monthly. Shift NOM calculator displays 8.835748%, that is J12 835,748%. 2. Calculate the market value PV. 60 N remaining payments. Press PV calculator displays 146,690.44 market value of the mortgage. Step 3. Calculate the market value of the offer. Plus 55,000 equals 201,690.9034 market value of the offer. Final answer C, 201,690. The market value of the offer is $201,609. Question 10. An appraiser has located a comparable where the sale price was $350,000, comprised of $185,000 cash and a $165,000 vendor take-back mortgage written at 4% per annum, compounded semi-annually, with monthly payments rounded to the next higher dollar, a 25-year amortization, and a 4-year term. Assuming that the market rate for similar financing is 6% per annum, compounded semi-annually, what should the appraiser regard as the sale price of the house? Round your final answer to the nearest $100. Step 1. Loan information. Based on the contract rate. 1. Convert the contract rate, J2 equals 4%, to monthly nominal rate, J12. 4. Shift nominal input. 2. Shift PYR, payments per year, semi-annual. Shift effective, J1 4.04%, effective annual rate. 12. Shift PYR, payments per year, monthly. Shift NOM, J12 equals 3.96768%. 2. Calculate monthly payment, PMT. 165,000, PV, loan amount. 300 N, total payments, 25 years times 12 months. 0 FV, fully amortized loan. Press PMT calculator displays -867.93339, 868 plus and minus sign, and then press PMT to round off the payment. 3. Calculate the outstanding balance at the end of the term, FV. Let's figure out the term. 4 times 12 equals 48 months. Enter 48, press Input, Shift, Amort. Press equal sign 3 times, calculator displays 148,252.628505. 148,252.63 plus and minus sign, and then press FV to round off the future value. Step 2. Calculate market value of the mortgage at the market rate. 1. Convert market rate J2 is 6% to monthly nominal rate J12. 6. Shift NOM nominal input. 2. Shift PYR payments per year semi-annual. Shift effective calculator stores J1 equals 6.09% effective annual rate. 12. Payments per year monthly. Shift NOM calculator displays 5.9263446%. That is J12 equals 5.9263446%. 2. Calculate the market value PV. 48. Remaining payments. Press PV display 154,044.907533, which is our market value of the mortgage. Step 3. Calculate the market value of the sale price, or market value of the offer. Add the cash portion, $185,000, to the market value of the mortgage. Market value of the offer equals $154,044.91 plus $185,000 equals $339,044.91. The sale price of the house is $339,000 rounded to the nearest $100, which is option B. Question 11. As a marketing incentive to speed up the sale of newly completed but unsold condominiums, a developer agrees to provide the buyers with first mortgages written at 8% rather than the going market rate of 13% if they pay the $45,000 asking price. Under these circumstances, the minimum all-cash offer with which the developer would likely be equally satisfied is which of the following situations? Correct answer, A, if the cash equivalent value less than $45,000. Explanation: the contract rate is 8%, while the market rate is 13%. The cash equivalent value is the market value of the mortgage if it were calculated at the market rate. Since the market rate, 13%, is higher than the contract rate, 8%, the present value of the mortgage payments at the market rate will be less than the $45,000 face value. Therefore, the cash equivalent value of the mortgage will be less than $45,000. So the correct answer is A. Question 12. Steve Johnson purchased a home 2 years ago, at which time he arranged for a mortgage for $175,000, amortized over 20 years, with a 5-year term and monthly payments. The interest rate on the mortgage was 7% per annum, compounded monthly, calling for monthly payments of $1,356.78 and an outstanding balance of $150,948.60 due at the end of the 5-year term. Steve has just received an offer on his house from Linda. Linda's offer consists of $45,000 cash and assumption of the existing mortgage for the remainder of the term. If current market rates for 3-year term mortgages are 5% per annum, compounded monthly, what is the market value of Linda's offer, rounded to the nearest dollar? Step 1. Understand the scenario. 1. Contract details. Initial loan amount, $175,000. Interest rate contract, 7% annually, compounded monthly. Monthly payment, $1,356.78. Outstanding balance, OSB, at the end of the 5-year term, $150,948.60. Remaining term, 3 years, 36 months. 2. Market interest rate. Current rate, 5% annually, compounded monthly, 5%. 3. Linda's offer, $45,000 cash. Assumption of the existing mortgage. Step 2. Calculate market value of the mortgage. To find the present value of the mortgage, we calculate the combined present value of 1. Remaining monthly payments of $1,356.78. 2. Outstanding balance, $150,948.60 at the end of the mortgage term. Step 3. Inputs for financial calculator. Market rate IYR equals 5J12. Payments per year, PYR equals 12. Monthly payment, PMT equals minus 1,356.78. Future value outstanding balance, FV equals minus 150,948.60. Number of months, N equals 36. Step 4. Calculate present value. PV equals 175,233.07. Step 5. Add cash payment. Linda's total offer value of mortgage plus cash payment equals 175,033.07 plus 45,233.07. Correct answer A, 220 out 233. Question 13. A mortgage loan with a face value of $100,000 is arranged through a mortgage broker. A commission of $3,500, appraisal fees of $450, as well as survey and legal fees totaling $600 will be deducted from the face value before the funds are advanced to the borrower. Calculate the cost of funds advanced to the borrower, expressed as an effective annual interest rate J1, if the loan is written at 7.75% per annum, compounded semi-annually, with monthly payments over a 20-year amortization period and term. Round your final answer to 2 decimal places. Step 1. Convert J2 equals 7.75% to J12 equals 7.75. Shift NOM, 2 Shift PYR. Shift effective, calculator stores J1 7.90156. 12 Shift PYR Shift NOM, calculator displays 7.62754, which is J1 quals 76277 Step 2. Solve for payment PMT, 100,000, PV, 240N, 20 years and 12 monthly payments. 0 FV. Press PMT, calculator display negative 813.42896, 813.42 plus and minus sign, and then press PMT to round off the payment. Step 3. Calculate the cost of funds advanced using a present value that is net of commission, appraisal, survey, and legal fees. Loan face value minus commission $3,500 minus appraisal fees $450 minus survey and legal fees $600 equals $95,450. Now let's set our loan face value, which is PV, $95,450 PV. Press IYR, calculator displays 8.252059, that is J12 equals 8.252059. Shift effective, calculator displays 8.571434, which is J1 8.571434. Thus, The correct answer is B, 8.57%. Question 14. Accurate appraiser is valuing a townhouse using the direct comparison approach. A house recently sold for $175,000, comprised of $85,000 cash and a $90,000 vendor-supplied mortgage written at 5% per annum, compounded semi-annually, with monthly payments sufficient to amortize the loan over 25 years and with a term of 5 years. At the time that the house sold, the market rate for similar mortgages was 7% per annum, compounded semi-annually. What price should Accurate Appraiser use if this sale is to be used as a comparable? Round your final answer to the nearest $10. The first step is to calculate the monthly payments at the contract rate. The second step is to calculate the OSB at the end of the term and set this equal to the future value. The third step is to calculate the market value of the mortgage at the market rate. The final step is to add on the down payment to find the market value of the townhouse. Step 1. Calculate the monthly payment using the contract rate, 5%. Convert the nominal annual rate, J2 equals 5%, to the monthly compounding rate, J12. 5. Shift to Shift PYR, Shift Effective. J1 of 5.0625. 12. Shift PYR. Shift NOM calculator displays 4.948699. J1 12.948899. 2. Solve for the monthly payment, PMT, 90,000 PV. 300N, 25 years times 12 months. 0 FV. Press PMT, calculator displays negative 523.44487. Enter 523.44, then press plus and minus sign, and then press PMT to round off the payment. Step 2. Calculate the outstanding balance, OSB, at the end of 5 years, 60 months. Use the amort function to calculate OSB 60. Input, shift amort. Press equal sign 3 times. Calculator displays per 6060 OSB equals 79657.19. Result, OSB equals 796657.6. Step 3. Calculate the market value of the mortgage using the market rate, 7%. Convert the nominal annual rate, J2 equals 7%, to the monthly compounding rate, J12. 7. Shift NOM2, Shift PYR, Shift Effective, Calculator stores, J1 7.1225. 12. Shift PYR, Shift NOM J12, 6.9047. 2. Solve for the present value, PV, 5 and 2344, PMT, 796576, FV, 6th remaining term. Press PV, calculator displays 82,968,212,749. Result, market value of the mortgage equals 82,968.21. Step 4. Add the cash down payment to the market value of the mortgage. Cash payment, $85,000. Market value of mortgage, $82,968.21. Total market value of offer, $85,000, plus 82 the 2 9 and 67 tholen 212749. Final answer, the market value of the townhouse is $167,970, rounded to the nearest $10. Correct option D. Question 15. 3 years ago, Jim bought a house, at which time he arranged a mortgage for $120,000. The loan was written at a rate of 6.75% per annum, compounded semi-annually, calling for monthly payments of $822.06 and an outstanding balance of $108,904.49 due at the end of the 5-year term. Jim has just received an offer from Alice to buy his house. Alice's offer consists of $25,000, cash and assumption of the existing financing for the remainder of the term. If current lending rates for 2-year term, mortgages are 8.75% per annum, compounded semi-annually, what is the market value of Alice's offer, rounded to the nearest dollar? The market value of Alice's offer is the market value of the mortgage plus her cash down payment. Alice will assume the remaining 24 monthly payments of $822.06 and the outstanding balance of $108,904.49. Calculate the market value of the mortgage by determining the PV of the payments and OSB remaining at the end of the original 5-year term, based on the current market rate of J equals 8.5%. Step 1. Convert the current market rate J2 equals 8.75% to the monthly compounding rate J12 8.75. Shift NOM. 2. Shift PYR. Shift Effective. Calculator stores J1 equals 8.941406. 12. Shift PYR. Shift NOM J-Quells 8.594631. Step 2. Calculate the present value PV of the remaining payments. Alice will assume the mortgage for the remaining 24 months, which includes monthly payment PMT $822.06 Outstanding balance FV, 108,949. Number of payments N, 24 months. 822.06 PMT, 108,904.49 FV, 24N. Press PV, calculator displays negative 109,829.017089, which is market value of mortgage, 109,829.2. Step 3. Add Alice's cash down payment to the market value of the mortgage. 1. Cash payment, $25,000. 2. Market value of mortgage, $109,829.02. Total market value of offer, $25,000 plus $109,829.02 equals $134,829.17089. Final answer. The market value of Alice's offer is $34,900 rounded to the nearest dollar. Correct option D. Question 16. An investor wants to decide whether to buy a mortgage written for $100,000 at J12 equals 3.5% that calls for monthly payments, a 20-year amortization, and a 5-year term. If the investor can earn J12 equals 6% with other investments, at what price should the mortgage be purchased, rounded to the nearest dollar? If the investor can earn J12 equals 6% on other investments, the purchase price of the mortgage should be based on a market value of J12 equals 6%. First, calculate the mortgage payment based on the contract rate of J12 equals 3.5%. Since this question also has a 5-year term, calculate the outstanding balance at the end of the 5-year term and set this amount equal to the future value with N equal to 60. Step 1. Calculate the monthly payment, PMT, at the contract rate. 3.5 IYR 12. Shift, PYR, 100,000, PV, 240N, 20 years times 12 monthly payments, 0 FV. Press PMT, calculator displays negative 579.959718, 57996 plus and minus sign, and then press PMT. Step 2, calculate the outstanding balance OSB at the end of 5 years. N equals 60, 5 years times 12 months. It'll 579.9660. Input, shift amort, calculator displays per 6060. Press equal sign 3 times. Calculator displays minus 81,126.556103. 81,126.56 plus and minus sign, and then press FV to round off FV. Step 3. Determine the market value of the mortgage at J12 equals 6%. Then calculate the present value PV, 6 IYR 60N. Press PV. Calculator displays 90,143.732174, which is market value of mortgage, rounded to the nearest dollar, is 90,144. Thus, the correct option is C. Question 17. Given that all other factors are identical, the longer the term of the contract on a bonused, partially amortized mortgage, where the bonus is paid by the borrower, is which of the following? Analysis. 1. Understanding a bonused, partially amortized mortgage. A bonus is an additional fee paid by the borrower at the start or end of the term. For a partially amortized loan, the borrower makes monthly payments that do not fully repay the principal by the end of the term, leaving an outstanding balance, balloon payment. 2. Impact of longer terms on effective interest rate. A longer term spreads the cost of the bonus over more months. This reduces the annualized cost of borrowing, lowering the effective interest rate, J1. 3. Why other options are incorrect. B. The effective interest rate decreases, not increases, with a longer term. C. Monthly payments would not increase just because the term is longer, they might decrease due to the extended payment period. D. The outstanding balance depends on the amortization schedule, not the term length. Correct answer. A. The lower the effective interest rate paid by the borrower. Question 18. Which of the following options best describes prepayment in a mortgage? Analysis. 1. Definition of prepayment. Prepayment is when the borrower pays off part or all of the mortgage balance ahead of schedule. Borrowers may do this to save on interest costs or to clear debt early. Other option, analysis. A. This describes acceleration, not prepayment, which is triggered by a default. B. Correct. Prepayment is the borrower's right to pay off some or all of the balance during the term, depending on the terms of the contract. C. This describes the balloon payment due at the end of a partially amortized loan, not prepayment. D. This refers to a broker's fee, unrelated to prepayment. 3. Legal context, Interest Act. Borrowers have the right to fully prepay a mortgage after 5 years, under the Interest Act, with a penalty of 3 months' interest in lieu of notice. Some mortgage contracts allow prepayment anytime within the term, with or without penalties. Question 19. A mortgage is arranged on the following terms. Mortgage face value, $170,000. Funds advanced, $163,500. Interest rate 2 equals 6.5%. Amortization period 20 years. Term 20 years. Payments, monthly, rounded up to the next higher $4. Calculate the rate of interest paid on funds advanced, expressed as an effective annual rate. Round your final answer 2 decimal places. Step 1. Convert J2 equals 6.5% to J12. 6.5 shift nom2 shift PYR. Shift effective calculator stores J1 equals 6.605625%. 12 shift PYR shift nom. Calculator displays J1 12 equals 6.413688. Step 2. Determine the monthly payment, PMT, based on the mortgage face value, $170,000, $170,000 PV, 240 20 years times 12 monthly payments, 0 FV. Press PMT. Calculator displays negative 1 blue 258.8579 plus and minus sign, and then press PMT to round off the payment. Step 3. Solve for the effective interest rate on the funds advanced, which is $163,500, $163,500 PV. Press IYR displays 6.91284, which is J112 equals 6.91284. Press Shift Effective to display J1 value. Calculator displays 7.521, which is J1 equal 135321. Final answer B, 7.14%. Question 20. An offer of $235,000 is accepted, comprised of a cash down payment of $85,000, subject to a vendor-supplied mortgage of $150,000 at 4% per annum, compounded semi-annually. The loan has an amortization period of 25 years, a term of 5 years, and calls for monthly payments rounded up to the next higher dollar. Market rates of interest for equivalent mortgages are currently 9% per annum, compounded semi-annually. What is market value of the offer, rounded to the nearest dollar? Find the payment and outstanding balance according to the loan contract, then value these amounts at the market rate. Add the cash down payment to obtain the market value of the offer. In this example, since the market interest rate is higher than the contract rate, the market value of the offer will be less than the stated offer price of $235,000. Step 1. Convert the contract rate J2 equals 4% to a monthly nominal rate J12. Shift nom. 2. Shift PYR. Shift effective. Calculator stores J1 4.4%. 12. Shift PYR. Shift nom. Calculator displays J12 equals 3.9678%. Step 2. Determine the monthly payment PMT based on the contract rate, $150,000 PV, 300N, 25 years times 12 monthly payments, 0 FV. Press PMT. Calculator displays 789-030308. Enter 790 plus and minus sign, and then press PMT to round off the payment. Calculate the outstanding balance OSB at the end of the 5-year term. 60. Input Shift Amort. Calculator displays per 6060. Press equal sign 3 times. Calculator displays 130 560.6387, 13056.64 plus and minus sign, and then FV to round off FV. Step 3. Value the mortgage at the market rate. J2 equals 9% to J12 9. Shift nom2. Shift PYR. Shift effective. Calculator stores J1's 9.205%. 12. Shift PYR. Shift nom. Calculator displays J12 8.83748%. 60N press PV. Calculator displays 122,246.785707. Market value of the mortgage. Add 85,000, which equals 207,246.785707. Market value of the offer. The market value of the offer is $207,047. Question 21. A mortgage broker has helped you set up a mortgage loan. The loan is for $350,000 at an interest rate of J12 equals 4.75% and a 20-year amortization. The loan calls for monthly payments of $2,262 over a 2-year term, with $327,975.95 owing at the end of 2 years. If the lender pays the broker a fee of 2% of the funds advanced, what is the yield to lender, expressed as an effective annual rate J1, rounded to 2 decimal places? 12 shift PYR, 357,000 PV, 2262 plus and minus sign, and then press PMT, 327,975 plus and minus sign, and then press FV 24N. Press IYR. Calculator displays 3.679894. That is J2 of 3.679894. Shift effective to determine J1 displays J1 3.742599. Conclusion. The yield to the lender is below the loan's interest rates. J12 equals 4.75%, which is the expected result given the payments are sufficient to pay off a $350,000 loan, but the lender is actually advancing $357,000. 2% times $350,000 plus $350,000. Therefore, the lender is being slightly underpaid with each payment. Given the inverse relationship between interest rates and present value, if the present value rises, then the interest rate drops. Therefore, the yield to the lender is 3.74%. Answer: A, 3.74%. Question 22. Which of the following statements concerning the Business Practices and Consumer Protection Act, BPCPA, is false? The false statement is C. A disclosure statement must be given to a borrower 6 days prior to the borrower incurring an obligation under a credit agreement, unless the time period is waived by the borrower. Explanation. A disclosure statement must be given to a borrower 2 days prior to the borrower incurring an obligation, not 6 days. Option A is true. Lenders and brokers must disclose the APR to the borrower. Option B is true. The APR includes both the borrower's contractual interest rate and any non-interest finance charges. Option D is true. Provincial governments in Canada have legislated disclosure requirements to help borrowers understand the actual cost of borrowing. Question 23. Mary has offered to purchase a house from a seller who is willing to provide partial financing. Mary's offer is a $75,000 down payment plus a mortgage of $125,000 at 4% per annum, compounded semi-annually. The loan is to be fully amortized with monthly payments of $755.31 over 20 years. If the market rate for similar mortgage loans is 7.5% per annum, compounded semi-annually, what is the market value of this offer, rounded to the nearest dollar? The market value of the mortgage is calculated by valuing the contracted loan payments at the market rate. The market value of the offer is the market value of the mortgage plus the cash down payment. 7.5 Shift NOM. 2. Shift PYR. Shift effective calculator stores J1 equals 7.640625. 12. Shift PYR Shift NOM. Calculator displays J112 equals 7.385429. Enter 755.31 plus and minus sign, and then press PMT. 240N, 20 years times 12 months, 0 FV. Press PV display 94 and 579.01487, market value of the mortgage, plus 75,000 equals 169,579.14897, market value of the offer. The market value of the offer is $169,570, rounded to the nearest dollar. Question 24. Although there is no legal obligation on the part of the lender to allow full repayment during the loan term in a closed mortgage with a term under 5 years, lenders typically allow prepayment of the remaining outstanding balance, but with a penalty of the greater of blank or the blank on the amount to be prepaid. Correct answer: A. 3 months interest, interest rate differential, IRD. Explanation. In the case of closed mortgages with terms under 5 years, lenders often permit prepayment of the outstanding balance, even though they are not legally required to do so. However, this permission usually comes with a penalty, which is calculated as the greater of 1. 3 months interest, or 2. The interest rate differential, IRD, which is the difference between the current interest rate and the rate of the original mortgage applied to the remaining balance. This penalty compensates the lender for potential losses incurred due to early repayment. Question 25. Terrence needs to borrow $200,000 to buy a studio apartment so he can move out of his East Vancouver basement suite. He saw an ad on the bus that said, "A bad credit, no problem. We loan to anyone." So he gave them a call. The potential lender was very friendly and said they could advance a loan of $200,000 with monthly payments of $1,400 over a 1-year term. The lender also gave Terrence a disclosure statement with a lot of fine print he didn't understand, which stated the face value of the loan is $224,000 and the outstanding balance at the end of 1-year loan term is $290,820.63. Calculate the cost of funds advanced, expressed as a J1, for this loan with a 1-year term. Round your final answer to 2 decimal places. 12. shift PYR, 200,000 PV, 1,400 plus and minus sign, and then press PMT, 219,820.63 plus and minus sign, and then press FV12N. Press IYR, calculator displays 17.5387, that is J12 equals 17.5387. Shift effective, calculator displays 19019559, which is J1 19019559. Question 26. A borrower has proposals from 4 lenders to advance funds of $122,000 as a mortgage loan. Payments on each loan will be made annually. Let's enter every alternative and find out the lowest rate. Alternative A, 6.6, shift nom 2, shift PYR, shift effective, 1 shift PYR, 125 and 500, PV 8 and 0, FV. Press PMT, calculator displays minus 278.724614. Enter 20,780.72 plus and minus sign PMT to round off payment, 122,000 PV. Press IYR, calculator displays 7.439903. Alternative B, 6.5, shift nom 2, shift PYR, shift effective 1, shift PYR, shift nom 125,000, PV5 N0 FV. Press PMT, calculator displays minus 3165.11379. 3165.11 plus and minus sign, and then press PMT. 122,000 PV, press IYR, calculator displays 7.513749. Alternative C, 6.75, shift nom shift PYR, shift effective 1, shift PYR, shift nom 4000 PV7N0 FV. Press PMT, calculator displays minus 22,899.546362, 22,899.55 plus and minus sign, and then press PMT. 122,000 PV, press IYR, calculator displays 7.331191. Alternative D7, shift nom 2, shift PYR, shift effective 1, shift PYR, shift nom 123,000 P, V6N0 FV, press PMT. Calculator displays negative 25,902.54921. 25,902.55 plus and minus sign to round off the payment. 122,000 P, press IYR, calculator displays 7.38116. Conclusion. Alternative C provides the lowest interest rate for the borrower. Question 27. A mortgage broker is arranging a partially amortized mortgage loan with a face value of $350,000. The loan contract is to be written at 6% per annum, compounded monthly. The repayment of the loan is to take place with monthly payments over an amortization period 15 years and a 5-year term. The borrower is to receive $336,000 as a result of a broker's commission of $10,000, a survey fee of $2,500, an appraisal fee of $500, and legal fees of $1,000, all of which are to be deducted from the face value. Calculate the cost of funds advanced to the borrower, expressed as an effective annual interest rate, J1. Round your final answer to 2 decimal places. Calculate the required payments according to the loan contract. Then calculate the cost of funds advanced using a face value, that is, net of commission fees. Using the financial calculator, punch in these values. 6 IYR, 12 shift PYR, 350,000 PV, 180 N, 15 years times 12 monthly payments, 0 FV. Press PMT, calculator display, minus 2953.49898, 2953.5 plus and minus sign, and then press PMT rounded payment. Step 2. Calculate the outstanding balance, OSB, after 5 years. Number of payments in 5 years, 60. Use amort. Function to find the outstanding balance, FV. 60. Input, shift, amort, calculator display, per 60 to 60. FV equals 266,031.76828, which rounds to 266,031.77. The outstanding balance, OSB, at the end of 5 years is 266,031.77. 1. Input into the financial calculator, 336,000 PV. We got it by $350,000 minus broker's commission of $10,000 minus a survey fee of $2,500 minus an appraisal fee of $500 minus legal fees of $1,000, which equals $336,000. 60 N press IYR. Calculator displays 7.64%, which is J12, nominal monthly rate. Step 4. Convert to effective annual rate J1. Press Shift Effective. Calculator displays 7.30%. That is J1 equals 7.30%. Final answer. The cost of funds advanced, expressed as an effective annual rate, J1 is 7.3%. Correct option A, 7%. Question 28. Given that all other factors are identical, the shorter the term of the contract on a bonused, partially amortized mortgage, where the bonus is paid by the borrower, is which of the following? The correct answer is B, the higher the effective interest rate paid by the borrower. Analysis. In a bonused mortgage, a bonus, additional cost, is amortized across the term of the loan. A shorter term means that the bonus is spread over fewer payments. This increases the annual cost of borrowing, resulting in a higher effective interest rate. The monthly payment, option C, may increase due to the shorter term, but this question focuses specifically on the effective interest rate. The outstanding balance, option D, depends on the amortization period, not the term length. Question 29. Although there is no legal obligation on the part of the lender to allow full repayment during the loan term in a closed mortgage with a term under 5 years, lenders typically allow prepayment of the remaining outstanding balance, but charge which of the following? The correct answer is C, a penalty of the greater of 3 months' interest or the interest rate differential, IRD, on the amount to be prepaid. In a closed mortgage with a term under 5 years, although there is no legal obligation to do so, lenders typically allow prepayment of the remaining outstanding balance, but with a penalty of the greater of 3 months' interest or the interest rate differential, IRD, on the amount to be prepaid. Question 30. A mortgage broker initiates a mortgage in the amount of $100,000 at J2 equals 5%, with an amortization period of 20 years, a term of 5 years, and monthly payments. The broker deducts a brokerage fee of $2,500 in addition to appraisal and legal fees totaling $750. Calculate the cost of funds advanced to the borrower, expressed as an effective annual rate, J1, rounded to 2 decimal places. The first step in answering this question is to calculate the payments based on the terms of the contract. The second step is to calculate the disclosure rate, which requires you to use the present value equal to the face value minus fees, $96,750. Converting the nominal interest rate, J2 equals 5%, to effective monthly rate, J12, 5 shift NOM, 2 shift PYR, shift effective. Calculator stores 5.0625, that is J1 equals 5.0625, 12, shift PYR, shift NOM. Calculator displays J112 equals 4.948699. Calculate payments based on the terms of the contract, 100,000 P, V240N, 20 years times 12 monthly payments, 0 FV. Press PMT. Calculator displays minus 657.12532, 657.13, plus and minus sign, and then press PMT, rounded payment. Final step. Calculate the disclosure rate. 60. Input, shift, amort, calculator displays, per 6060. Press equal sign 3 times. Calculator displays 83,378.06418, 83378.06 plus and minus sign, and then press FV to round it to the nearest cent, 96,750 PV. Total fees deducted from the loan are face value of the loan, $100,000, minus brokerage fee, $2,500, minus appraisal and legal fees, $750, equals $90,670.50. 60 NPress IYR. Calculator displays 5.75819, which is J12. Press Shift Effective. Calculator displays 5.912962, which is J1. Final answer. The cost of funds advanced to the borrower is option D, 5.91%, rounded to 2 decimal places. Question 31. Mike bought a house 2 years ago, at which time he arranged a $110,000 mortgage. This loan was written at a nominal rate of 9.5% per annum, compounded semi-annually, with a 10-year term and amortization period, and monthly payments of $413. Today, Mike has received an offer from Andre to buy his house for $50,000 cash plus assumption of his mortgage. If current mortgage rates for similar mortgages are 12% per annum, compounded semi-annually, what is the market value of Andre's offer, rounded to the nearest dollar? Find the new PV, given that the payments remain at $1,430, but the market value of the mortgage changes because the new rates are 12% per annum, compounded semi-annually. This rate is higher than the contract rate, therefore, we would expect the PV of the loan to be lower. Also, we only have 8 years or 96N left on the mortgage. Determine the market rate of the mortgage. Convert J2 12% to monthly rate J12 12. Shift NOM2, shift PYR, shift effective, calculator stores 12.36 as J1, 12 shift PYR, shift nom, calculator displays 11.71053, which is J1 12 11.71053. Step 2. Find the market value of the remaining mortgage. 96N, 8 years times 12 payments each year, remaining on the loan. 113 plus and minus sign, and then press PMT, monthly payment remains unchanged. 0 FV, loan fully amortized at the end of the term. Press PV, display 87795.457654, market value of mortgage. Add, cash offer 50,000, equals 137,795.457654, market value of the offer. The market value of Andre's offer is $137.95. Question 32. An appraiser has located a comparable where the sale price was $220,000, comprised of a $105,000 cash and a $115,000 vendor take-back mortgage written at 3.5% per annum, compounded semi-annually, with monthly payments sufficient to fully amortize the loan over 20 years. Assuming that the market rate for similar financing is 5% per annum, compounded semi-annually, what should the appraiser regard as the sale price of the house, rounded to the nearest $100? Calculate the payments according to the contract, then value the payments according to the market rate. Add the cash down payment to the market value of the mortgage to find the sale price. Step 1. Calculate the monthly payment based on the contract rate. J2 equals 3.5%. 3.5 shift nom. 2 shift PYR, shift effective, calculator stores J1E.530625, 12 shift PYR, shift nom, calculator displays J2 of 3.74749. To calculate the monthly payment, 115,000 PV, 240N, 20 years times 12 monthly payments, 0 FV. Press PMT, calculator displays, minus 665.46245, 565.46, plus and minus sign, then press PMT, rounded payment. Step 2. Value the payments using the market rate J2 equals 5%. 5. Shift nom 2. Shift PYR. Shift effective. Calculator stores J1 equals 5.0625. 12. Shift PYR. Shift nom. Calculator displays J1 4.948699. Step 3. Calculate the market value of the mortgage payments. Then calculate the sale price of the house. 1. Press PV. Calculator displays 101,268.39994, which is market value of the mortgage, so rounded to the nearest dollar, it is $101,268. 2. Add cash payment, $101,268 plus $105,000 equals $206,068, rounded to the nearest 100, $206,300. The sale price of the house is $206,300, rounded to the nearest $100. Question 33. A mortgage broker has helped you set up a mortgage loan. The loan is for $250,000 at an interest rate of J12 equals 4.5% and a 20-year amortization. The loan calls for monthly payments of $1,582 over a 3-year term with $225,208.61 owing at the end of 3 years. If the lender pays the broker a fee of 2% of the funds advanced, what is the yield to the lender, expressed as an effective annual rate JL, rounded to 2 decimal places? Step 1. Determine the funds advanced to the borrower. Loan amount equals $250,000. Broker fee equals 2% times $250,000 equals $5,000. Funds advanced by the lender equals $250,000 plus $5,000 equals $255,000. Step 2. Calculate the nominal monthly interest rate, J12. 1. Input the loan details into the financial calculator. 12. Shift PYR, monthly payments. 255,000 PV funds advanced by the lender. 1,582 plus and minus sign PMT, monthly payments. 225,208.61 plus and minus sign FV, amount owing after 3 years. 36N, 3 years times 12 monthly payments. 2. Solve for IYR, nominal monthly rate. Press IYR, calculator displays 3.759815%, which is JT equals 3.759815%. Step 3. Determine to effective annual rate J1. Press Shift Effective, calculator displays J1 equals 3.82528%. Final answer. The yield to the lender, expressed as an effective annual rate, is 3.83%, option D. The yield to the lender is lower than the loan's interest rate, J12 equals 4.5%, because the lender pays a broker fee, effectively reducing their return. The loan payments are sufficient to repay a $250,000 loan, but the lender advanced $255,000, resulting in a slightly lower yield. Question 34. A mortgage broker will advance $97,000 to a borrower who has agreed to pay a brokerage fee of $2,200. As a consequence, the face value of the loan will be $99,200. The loan will be amortized over 25 years with monthly payments at J2 equals 6%. Calculate the monthly payment required to amortize the loan. Step 1. Convert the nominal interest rate, J2 equals 6%, to the effective monthly rate, J12. 6. Shift NOM2, Shift PYR, Shift Effective. Calculator displays J1 equals 6.9% effective annual rate. 12. Shift PYR, Shift NOM. Calculator displays J12 equals 5.92634.6%. Step 2. Calculate the monthly payment. 1. Input loan details into the financial calculator. 99,200 P.V. Face value of the loan. 300, 25 years, times 12 monthly payments. 0 F.V. Loan is fully amortized. 2. Solve for PMT. Press PMT. Calculator displays negative 634.6817. Final answer. The monthly payment required to amortize the loan is $634.69, option B. Explanation. The payment calculation accounts for the full face value of the loan, $99,200, even though the borrower only received $97,000. This is because the brokerage fee is financed as part of the loan. Question 35. Although there is no legal obligation on the part of the lender to allow full repayment during the loan term, in a closed mortgage with a term under 5 years, lenders typically allow prepayment of the remaining outstanding balance, but charge which of the following? Correct answer, D. A penalty of the greater of 3 months' interest or the interest rate differential, IRD, on the amount to be prepaid. Explanation. In a closed mortgage with a term under 5 years, prepayment of the remaining outstanding balance is generally allowed by lenders, but is subject to a penalty. This penalty is typically calculated as the greater of 1. 3 months' interest on the amount to be prepaid. 2. Interest rate differential, IRD. The difference between the interest rate on the mortgage contract and the lender's current posted rate for the remaining term of the mortgage. This ensures that the lender is compensated for the potential loss due to the early repayment. Question 36. Which of the following is true regarding the annual percentage rate, APR? Correct answer, C. It is the borrower's contractual interest rate plus any non-interest finance charges. Explanation. The annual percentage rate, APR, is a measure of the total cost of borrowing expressed as an annualized rate. It includes the borrower's contractual interest rate, also called the nominal or stated rate, non-interest financing charges, such as brokerage fees, bonuses, or administrative costs. This provides borrowers with a standardized way to compare the true cost of different loan options. Why other options are incorrect? A. Incorrect. The APR is not a requirement under the Federal Interest Act. It is a disclosure requirement under other regulatory frameworks, such as the cost of borrowing disclosure rules. B. Incorrect. The APR differs from the stated interest rate because it incorporates non-interest financing charges. D. Incorrect. The APR is not tied to semi-annual compounding. It is an annualized measure. Question 37. A local mortgage broker has arranged a mortgage for $240,000. The borrower has agreed to pay a brokerage fee of $5,000 that is to be added to the loan amount, giving a face value of $245,000 for the loan. The mortgage bears interest at a contract rate of 8% per annum, compounded quarterly. The mortgage has a term and amortization period of 25 years. The loan is to be repaid using monthly payments. What is the equivalent periodic interest rate, expressed as a rate per month on the funds advanced? Round your final answer to 2 decimal places. Calculate the contract payments based on the face value of the loan, then find the periodic interest rate based on the funds advanced. Step 1. Convert the nominal annual rate, J4 equals 8%, to the monthly rate, J12. Enter 8, Shift NOM. Enter 4, Shift PYR. Press Shift Effective. Calculator stores J1 equals 8.243216%. Enter 12, Shift PYR. Press Shift NOM equals 7.9472551%, nominal monthly rate. Step 2, calculate the monthly payment based on the loan's face value. Enter 245,000 PV loan face value. Enter 300N, 25 years times 12 months. Enter 0FV, fully amortized loan. Press PMT, calculator displays negative 18882.39635, 1882.4, plus and minus sign, and then press PMT rounded payment. Step 3. Find the monthly interest rate based on funds advanced. Enter 240,000 PV, funds advanced excluding brokerage fee. Press IYR, calculator displays J12 equals 8.188328%. Convert this to the monthly rate. Monthly rate equals 8.188328 divided by 12 equals 0.682361%. Final answer. The cost of funds advanced, expressed as a rate per month, is 0.68%. Question 38. Jim Dixon is interested in purchasing Josephine Topanga's condominium for the listed price of $250,000. Jim proposes to pay $80,000 in cash, and he wants Josephine to take back a mortgage for the balance. The rate on the suggested mortgage is J2 equals 5%, and the loan is to be fully amortized with monthly payments over 20 years. The market rate for similar mortgages is J2 equals 8%. What is the market value of Jim's offer, rounded to the nearest $10? For this question, calculate the mortgage payments based on the original contract rate. Then, calculate the market value of the mortgage and add it to the down payment to calculate the market value of offer. Step 1. Calculate monthly payment using the original contract rate, J2 equals 5%. Enter 5, Shift NOM. Enter 2, Shift PYR. Press Shift Effective, calculator stores J1 equals 5.0625 per Shift PYR. Press Shift NOM J12 4.948699%. Nominal annual rate. Now determine the monthly payment. Enter 170,000 PV, loan amount $250,000 minus $80,000. Enter 240 N, 20 years times 12 months. Enter 0FV, fully amortized loan. Press PMT, calculator displays negative 1,117.112554, 1117.11, plus and minus sign, then press PMT rounded payment. Step 2, calculate the market value of the mortgage using J2 equals 8%. Enter 8, Shift NOM. Enter 2, Shift PYR. Press Shift Effective. J1 8.16%. Enter 12, Shift PYR. Press Shift NOM. J12 equals 7.869836%, nominal annual rate. Now calculate the present value market value. Press PV, calculator displays 134,858.42629. Step 3. Calculate the market value of Jim's offer. Market value of offer equals market value of mortgage plus down payment. Market value of offer equals 134,858.44 plus 804,258.44. Rounded to the nearest 10, 204,860. Final answer, A, 240,060. Question 39. A developer is offering a mortgage loan of $102,000 at 9.25% per annum, compounded semi-annually, on each of 16 units in a condominium development. The mortgages have monthly payments, 5-year terms, and 20-year amortization periods. Each unit is priced at $132,000, and the units have been selling over the past 7 months. Even with a recent decrease in interest rates, currently at J2 8%, the property has attracted the attention of a buyer who has made a full price offer and applied for the developer's financing on one of the condominium units. What is the market value of the offer, rounded to the nearest dollar? The first step for this question is to calculate the monthly payment and outstanding balance owing at the end of the 5-year term based on the contract interest rate. The second step is to calculate the market value of the mortgage based on the market rate. The final step is to calculate the market value of the offer. Since each unit is priced at $132,000 and the mortgage loan is for $102,000, the down payment is $30,000. To calculate the market value of the offer, add the cash down payment to the market value of the mortgage. Step 1. Calculate the monthly payment based on contract rate. J2 equals 9.25%. Enter 9.25, Shift NOM. Enter 2, Shift PYR, press Shift Effective. Calculator stores J1 equals 9.46396%. Enter 12, Shift PYR, press Shift NOM, J12 is 9.076624%. Now calculate the monthly payment. Enter 102,000 PV loan amount. Enter 240N, 20 years times 12 monthly payments. Enter 0FV, fully amortized loan. Press PMT, calculator displays negative 922.752986. 92275 plus and minus SING, and then press PMT, rounded payment. Step 2. Calculate the outstanding balance owing at the end of the 5-year term. Enter 60. Input Shift Amort for the first 5 years. Calculator displays per 60/60. Press =sign 3 times. Calculator displays 9057.19331. 90,570.11 plus and minus sign. Then press FV rounded FV. Step 3. Calculate the market value of the mortgage based on market rate. J2 = 8%. Enter 8. Shift NOM. Enter 2. Shift PYR. Press Shift Effective Calculator stores J1 = 8.16%. Enter 12. Shift PYR. Press Shift NOM. Calculator displays J12 7.869836%. Now calculate the market value. Enter 60N, remaining 60 months of payments. Enter 922.75 plus and minus sign and press PMT, rounded payment. Enter 90,507.11 plus and minus sign FV, outstanding balance. Press PV. Calculator displays 106,834.620887. Rounded PV = 106,835. Step 4. Calculate the market value of the offer. Market value of offer = market value of mortgage plus down payment. Market value of offer = 106,835 plus 30,000 = 136,835. Final answer A, 35. Question 40. Sam and Sally recently negotiated a second mortgage in the amount of $25,000 at an interest rate of 9% per annum, compounded semi-annually. The loan is to be amortized over 20 years by monthly payments. As a result of a $3,000 brokerage fee, assume that only $22,000 of the loan's $25,000 face value is advanced to Sam and Sally. The effective annual rate of interest charged on the funds advanced will be which of the following? Step 1. Determine the monthly payment PMT based on contract rate. 9. Shift NOM. 2. Shift PYR. Compounding frequency. 2. Press Shift Effective. Calculator stores J1 = 9.2025%. Effective annual rate based on contract rate. 12. Shift PYR. Monthly compounding. Press Shift NOM. Calculator displays J12 = 8.35748%. Nominal monthly rate based on contract rate. Step 2. Calculate monthly payment. Enter 25,000 PV, face value of the loan. Enter 240N, 20 years times 12 monthly payments. Enter 0FV, fully amortized loan. Press PMT. Calculator displays negative 222.29734. Rounded payment equals $222.30. Enter 222.3 plus and minus sign PMT, rounded payment. Step 2. Calculate the effective interest rate based on funds advanced. 1. Adjust for actual funds advanced. The lender advances $22,000 after deducting fees from the $25,000 face value. 2. Calculate the actual interest rate. Enter 22,000 PV, actual funds advanced. Enter 222.32 plus and minus sign, and then PMT, monthly payment from step 1. Enter 240N, same term and amortization period. Enter 0 FV, fully amortized loan. Press IYR. Calculator displays 10.67937%. Nominal monthly interest rate. 3. Find the effective annual rate. Press Shift Effective. Calculator displays J1 = 11.217868%. Effective annual interest rate on funds advanced. Interpretation. The cost of funds advanced, 11.22%, is higher than the contract equivalent rate, 9.20%. This increase reflects the effect of reducing the present value due to upfront deductions like fees, while maintaining the same payment structure. As the present value declines, the interest rate rises, which aligns with the inverse relationship between present value and interest rates. Conclusion. The effective annual interest rate, J1, on the funds advanced is 11.22%, which is significantly higher than the contract rate due to the fee adjustments. Question 41. A loan contract was written for a face value of $50,000 at J2 10.75%, with a 20-year amortization and a 5-year term. Payments were to be made monthly for $499.76, and the outstanding balance at the end of the term was $45,167.50. A brokerage fee of $2,000 was deducted from the face value, so the funds actually advanced to the borrower were $48,000. What is the effective annual rate of interest on the funds advanced, rounded to 2 decimal places? Find the effective annual rate of interest on the funds advanced given the contract terms. 12. Shift PYR, 12 compounding periods per year for monthly payments. Enter 48,000 PV, present value funds advanced. Enter 499.76 plus and minus sign and press PMT, monthly payment. Enter 60N, term equal 5 years times 12 months. Enter 45,167.5 plus and minus sign FV, outstanding balance at the end of the term. Press IYR. Calculator displays J12 value 11.61804%. Press Shift Effective. Calculator displays 12.25794%, which is J1. Therefore, the effective annual interest rate, J1, on the funds advanced is 12.26%, rounded to 2 decimal places. Final answer, option A, 12.26%. Question 42. As a marketing incentive to speed up the sale of newly completed but unsold condominiums, a developer agrees to provide the purchasers with first mortgages with a contract rate that is lower than the market rate of interest. Under these circumstances, it can be said that this is an offer involving which of the following? The correct answer is A, below market rate financing. Below market rate financing refers to situations where a lender or developer offers a loan with an interest rate lower than the prevailing market rate. This is often used as a sales incentive, as seen in this case where the developer is trying to sell unsold condominiums. Incorrect options. B, market rate financing. Incorrect, because the rate offered is explicitly lower than the current market rate. C, above market rate financing. Incorrect, as the rate is below, not above, the market rate. D, interest-only financing. Incorrect, because the question does not indicate that the loan requires interest-only payments. Question 43. A mortgage broker is arranging a fully amortized mortgage loan with a face value of $240,000. The loan contract is to be written at 8% per annum, compounded semi-annually. The repayment of the loan is to take place over 15 years with monthly payments. The borrower is to receive $228,400 as a result of a broker's commission of $8,000, a survey fee of $2,000, an appraisal fee of $600, and legal fees of $1,000, all of which are to be deducted from the face value. Calculate the cost of funds advanced to the borrower, expressed as an effective annual interest rate, J1, rounded to 2 decimal places. Calculate the required payments according to the loan contract. Then calculate the cost of funds advanced using a present value that is net of commission, appraisal, survey, and legal fees. 8. Shift NOM 2. Shift PYR. Shift effective. Calculator stores J1 equals 8.16. 12. Shift PYR. Shift NOM J12 7.869836. 240,000 PV 100. 180 N 15 years times 12 months 0 FV. Press PMT. Calculator displays negative 2,275.567074. 2,275.57 plus and minus sign and press PMT, rounded payment. 220,400 PV. Net funds advanced equals $240,000 minus $8,000 minus $2,000 minus $600 minus $1,000 equals $228,400. Press IYR. Calculator displays 8.69795, which is J12. Shift effective 9.051965. Conclusion: the effective annual interest rate on the funds advanced is 9.05%, which is option D. Question 44. 2 years ago, Bert bought a beautiful lakefront estate for $750,000. Bert made the purchase with a $250,000 down payment and financed the remainder with a mortgage loan written at a contract rate of J2 equals 7.5%. calling for monthly payments of $3,994 and an outstanding balance of $433,794 due at the end of the 5-year term. Ernie has made an offer of a $240,000 down payment and assumption of the existing financing for the remainder of the term. If the current market interest rates for 3-year term mortgages is J1 equals 10%, what is the market value of Ernie's offer, rounded to the nearest dollar? Ernie assumes responsibility for the remaining 36 monthly payments of $3,994 and the outstanding balance of $433,709.14. Calculate the market value of the mortgage by determining the PV of the remaining payments and OSB at the end of the original 5-year term based on the current market rate of J1 equals 10%. The market value of the offer is the market value of the mortgage plus the cash down payment. 10. Shift NOM1 Shift PYR. Shift effective. Calculator stores J1 equals 10. 12. Shift PYR. Shift NOM. Calculator displays J12 equals 9.568969. 36N, remaining months. 3,994, plus and minus sign, and then press PMT, monthly payments. 433,709.14, plus and minus, then press FV, outstanding balance. Press PV. Calculator displays 454.10.81187, which is market value of the mortgage. Add 240,000 equals 690,410.81187, that is market value of the offer. The market value of the offer is A, 690,411 rounded to the nearest dollar. Question 45. Which of the following is true regarding a portable mortgage? The correct answer is B. A borrower can save money when the existing mortgage has a lower interest rate than current market rates. This is the primary benefit of a portable mortgage. If the borrower's existing mortgage has a lower interest rate than current market rates, they can avoid paying the higher rates by transferring the mortgage to a new property. Explanation of other options. Option A. A purchaser takes over responsibility for the remaining contractual terms of an existing mortgage. Incorrect. This describes an assumption of the mortgage, not a portable mortgage. In a portable mortgage, the borrower can transfer the mortgage balance to a new home, but they are not taking over the mortgage, they carry it with them to the new property. Option C. The vendor creates a vendor-supplied mortgage. Incorrect. A portable mortgage is typically arranged by the lender and is not a vendor-supplied mortgage. A vendor-supplied mortgage refers to a situation where the seller provides financing to the buyer. Option D. The portable funds fee, PFF, is always charged. Incorrect. A portable mortgage does not necessarily involve a portable funds PFF. Fees may apply, but they are not always charged. Question 46. A local mortgage broker arranged a mortgage for $210,000. The borrower has agreed to pay a brokerage fee of $7,200 that is to be added to the loan amount, giving a face value of $270,200 for the loan. The mortgage bears interest at a rate of 6.5% per annum, compounded semi-annually. The mortgage has an amortization period and term of 20 years and calls for monthly payments. If the mortgage is to be sold to an investor for $225,000 immediately after the loan is initiated, what rate will the investor earn, expressed as an annual rate with semi-annual compounding? Round your final answer to 2 decimal places. To find the nominal interest rate with semi-annual compounding, calculate the payment based on the face value of the loan of $270,200. Then, calculate the investor's yield based on the loan payment and the amount that the investor pays, $225,000. 6.5 Shift 2 Shift PYR, Shift Effective. Calculator stores J1 equals 6.605625. 12 Shift PYR, Shift NOM. Calculator displays J12 equals 6.413688. 207,200 PV. 240 N. 20 years times 12 monthly payments. 0 FV. Press PMT. Calculator displays negative 1608.366906. 1608.37 plus and minus sign. Then press PMT to round of payment. Final step. Use the amount the investor pays as the new PV to calculate the yield. The calculator steps continue as follows. 225,000 PV. Press IYR. Calculator displays 5.972251. That is J12. Shift Effective. Calculator displays 6.138471. That is J1. 2 Shift PYR. Shift NOM. Calculator displays 6.4754. That is J2. Question 47. Sarah wants to purchase Bart's property. Sarah cannot qualify for financing, so she has offered to give Bart $50,000 in cash plus assume the existing $25,195 mortgage loan. This loan has 233 monthly payments of $1,050 remaining. The interest rate on the original mortgage is J2 equals 8%, but the current market rate is J2 equals 5.5%. What is the market value of the offer, rounded to the nearest dollar? The market value of Sarah's offer is the market value of the mortgage plus her cash down payment. Sarah will assume the remaining 233 monthly payments of $50. Calculate the market value of the mortgage by determining the PV of the remaining payments based on the current market rate of J2 equals 5 and 5%. 5.5 Shift NOM. 2 Shift PYR. Shift Effective. Calculator stores J1 equals 5.75625. 12 Shift PYR. Shift NOM. Calculator displays J12 equals 5.438018. 1050 plus and minus sign, and then press PMT. 233 N0FV, press PV. Calculator displays 150 903.7664, market value of the mortgage. Add 50,000 equals 200 going 903.764, market value of the offer. The market value of Sarah's offer is 200,904. Question 48. Alex Dupuy wants to purchase Joe Bernardo's property. Alex would like to pay $35,000 in cash and take over the existing mortgage that has 233 monthly payments of $900 remaining on the mortgage loan. The interest rate on the original mortgage is J2 equals 9%, but the current market rate is J2 equals 6%. What is the market value of the offer, rounded to the nearest dollar? The market value of Alex's offer is the market value of the mortgage plus his cash down payment. Alex will assume the remaining 233 monthly payments of $900. Calculate the market value of the mortgage by determining the PV of the remaining payments based on the current market rate of J2 6%. 6. Shift NOM 2. Shift PYR. Shift effective. Calculator stores J1 6.09. 12. Shift PYR. Shift NOM. Calculator displays J12 5926346. 900 plus and minus sign, and then press PMT0FV 233N. Press PV. Calculator displays 124 4 ton 10 88954, market value of the mortgage, plus 35,000 equals 159,410 88954, market value of the offer. The market value of the offer is $159,411. Question 49. A local mortgage broker arranged a mortgage for $210,000. The borrower has agreed to pay a brokerage fee of $7,200 that is to be added to the loan amount, giving a face value of $270,200 for the loan. The mortgage bears interest at a contract rate of 4.5% per annum, compounded semi-annually. The mortgage has an amortization period and term of 20 years and calls for monthly payments. If the mortgage is sold to an investor for $225,000, immediately after the loan is initiated, what rate will the investor earn, expressed as an annual rate with semi-annual compounding? Round your final answer to 2 decimal places. The first step to solving this problem is to find the monthly payments that the borrower has to make. 4.5. Shift NOM. 2. Shift PYR. Shift effective. Calculator stores J1 equal 455625. 12. Shift PYR. Shift NOM. Calculator displays J12 equal 4.458383. 27200 PV. 240N. 20 years times 12 months. 0 FV. Press PMT. Calculator displays negative 1369.239998. 1369.24 plus and minus sign, and then press PMT, rounded payment. The investor is paying $225,000 for the right to receive the monthly payments of $1,369.24 for 20 years. To determine the investor's rate of return expressed as a nominal interest rate, compounded semi-annually, the calculator steps are as follows. $225,000 PV. Press IYR. Calculator displays 4.48729, which is J12. Shift effective. Calculator displays 4.14712, that is J1. 2. Shift PYR. Shift NOM. Calculator displays 4.8334, J2. Final answer. The rate the investor will earn, expressed as an annual rate with semi-annual compounding, is 4.08%. Answer A, 4.8%. Question 50. Mr. Dunnigan has agreed to sell his prime Vancouver home to his friend, Mr. Flutie. Mr. Flutie's offer consists of $55,000 cash and financing the remainder by way of a vendor take-back mortgage. The vendor take-back mortgage would be written for $375,000 at 11.75% per annum, compounded semi-annually, an amortization period of 25 years, a term of 5 years, and monthly payments. Market rates of interest for equivalent mortgages are currently 13% per annum, compounded semi-annually. What is the market value of Flutie's offer, rounded to the nearest tenors? 11.75. Shift NOM. Shift PYR. Shift effective. Calculator stores J1 equals 12.9556. 12. Shift PYR. Shift NOM. Calculator displays J12 11.47285 375,000 PV. 300N. 20 years times 12 monthly payments. 0 FV. Press PMT. Calculator displays negative 3804.161605. 3804.16, plus and minus sign, and then press PMT, rounded payment. Calculate the outstanding balance after 5 years. 60. Input Shift Amort. Calculator displays per 6060. Press equal sign 3 times. Calculator display 357,359.25413, the remaining balance at the end of the term. 357,359.26 plus and minus sign, and then press FV, rounded FV. Now enter the market rate and determine the market value. The calculator steps continue as follows. 13 Shift Num2 Shift PYR Shift Effective. Calculator displays J1 134225 Shift Nom. Calculator displays J12 equals 12.661289. 60N, press PV. Calculator displays 358 bound 848 893364, which is our market value of the mortgage. Add 55,000 equals 43 and 89364, which is our market value of the offer. Thus, the market value of Flutie's offer is $403,850, rounded to the nearest 10. Question 51. Although there is no legal obligation on the part of the lender to allow full repayment during the loan term in a closed mortgage with a term under 5 years, lenders typically allow prepayment of the remaining outstanding balance, but with a penalty of the blank of blank or the blank on the amount to be prepaid. In a closed mortgage with a term of under 5 years, lenders typically allow prepayment of the remaining balance, but they impose a penalty for doing so. The penalty is the greater of the following 2 options. 1. 3 months interest. This is a fixed amount based on the interest rate and the outstanding balance of the loan. 2. Interest rate differential, IRD. This represents the difference between the original mortgage rate and the current market rate, applied to the amount being prepaid. This is done to compensate the lender for the lost interest income from the early repayment. Therefore, the correct penalty is the greater of the 2 amounts. Question 52. A mortgage loan with a face value of $150,000 is arranged through a mortgage broker. A commission of $4,000, appraisal fees of $450, as well as survey and legal fees totaling $700 will be deducted from the face value before the funds are advanced to the borrower. Calculate the cost of funds advanced to the borrower, expressed as an effective annual interest rate, J1, if the loan is written at 6.75% per annum, compounded semi-annually, with monthly payments over a 20-year amortization period and a 5-year term. Round your final answer to 2 decimal places. Calculate the required payments according to the loan contract. Then calculate the cost of funds advanced using a face value that is net of commission fees. 6.75 Shift Nom. 2 Shift PYR. Shift Effective. Calculator stores J1 equals 6.863906. 12 Shift PYR. Monthly payments. Shift Nom. Calculator displays J12 6.65699. 150,000 PV. 240 N. 20 years times 12 months. 0 FV. Press PMT. Calculate net 1,132,26645. 12327 plus and minus sign, and press PMT, rounded payment. Calculate the present value of the first 60 payments, the term. 60. Input Shift Amort. Calculator displays per 6060. Press equal sign 3 times. Calculator displays 128,701.364204, which is the remaining balance after 5 years. 128,701.36 plus and minus sign, and then press FV, rounded FV. Calculate the cost of funds advanced based on the net loan value. 144,850p, which is amount advanced to the borrower. We got it by $150,000 minus 4,000 minus 450 minus $700, which equals 144,850. 60N, 5 years times 60 months. Press IYR calculator display 7.537423. That is J12 equals 7.537423. Shift effective calculator displays 7.8344. That is J1 equals 7.83344. Final answer. The cost of funds advanced to the borrower is 7.80%. Therefore, the correct answer is A, 7.80%. Question 53. As one lowers a discount or expected yield rate, the present value of a given series of future payments does which of the following? The correct answer is C. It increases. Present value, PV, refers to the value of future payments, like loan payments or annuities, in today's terms. When you lower the discount rate or expected yield, it means you're discounting future payments less. In other words, the present value of those payments increases. If the rate is lower, the future payments are worth more today because you're discounting them by a smaller amount. So, lowering the discount rate increases the present value of future payments. Why the other options are incorrect. Option A, it decreases. This is incorrect because lowering the discount rate makes the present value increase, not decrease. Option B, it could go up or down depending on the timing of the payments. While the timing of payments does affect the present value, the discount rate alone determines that the present value will increase when lowered. So this option is not correct. Option D, it remains constant. This is also incorrect because the present value changes when the discount rate changes. It doesn't remain constant. Question 54. A local mortgage broker arranged a mortgage for $210,000. The borrower has agreed to pay a brokerage fee of $7,200 that is to be added to the loan amount, giving a face value of $207,200 for the loan. The mortgage bears interest at a contract rate of 11.5% per annum, compounded monthly. The mortgage has an amortization period and term of 20 years and calls for monthly payments. If the mortgage is to be sold to an investor for $220,500 immediately after the loan is initiated, what rate will the investor earn, expressed as an annual rate with semi-annual compounding, J2? Round your final answer to 2 decimal places. Set the face value of $270,200 equal to the present value. To calculate the nominal interest rate that the investor will earn, change the present value to $220,500, the amount that the investor pays. Enter 11.5 and press IYR 12, Shift PYR. 27,200 PV, the face value of the loan. 240 N, 20 years times 12 months. 0 FV, since the loan is fully amortizing. Press PMT, calculator displays negative 2360.2856 to 29 plus and minus sign, and then press PMT, rounded payment. Determine the rate the investor earns, $220,500, PV, the amount the investor pays. Press IYR, calculator displays negative 11.267747 per annum compounded monthly, J12. Shift effective, calculator displays 11.868261, which is J1 equals 11.868261. 2. Shift PYR. Shift NOM, calculator displays 11.53586, that is J2 11.53586. Final answer, the rate the investor will earn, expressed as an annual rate with semi-annual compounding, J2, is 11.54%. Question 55. Bill Black purchased a home 2 years ago, at which time he arranged for a mortgage for $350,000, amortized over 20 years with a 5-year term and monthly payments. The interest rate on the mortgage was 6% per annum, compounded semi-annually, calling for monthly payments of $2,493 and an outstanding balance of $296,089, due at the end of the 5-year term. Bill has just received an offer on his house from Mark. Mark's offer consists of $50,000 cash and assumption of the existing mortgage for the remainder of the term. If current market rates for 3-year term mortgages are 3.5% per annum, compounded semi-annually, what is the market value of Mark's offer, rounded to the nearest dollar? The value of Mark's offer is the market value of the mortgage plus his cash down payment. Mark will assume the remaining 36 monthly payments of $2,493 and the outstanding balance of $296,762.89. Calculate the market value of the mortgage by determining the PV of the payments and OSB remaining at the end of the original 5-year term based on the current market rate of J2 equals 3.5%. Calculate the present value, PV, of the mortgage. 3.5, Shift, NOM 2, Shift PYR. Shift effective, calculator stores J1 equals 3.53625, 12, Shift PYR. Shift NOM, calculator displays J12 equals 3.474749, 2493 plus and minus sign, and then press PMT, the remaining payments, 296,762.89 plus and minus sign, and press FV, outstanding balance, 36N, number of payments remaining. Calculate the market value of Mark's offer. Press PV, calculator displays 352,537.42204. Market value of the mortgage, add 5,000 equals 402,537.42204 market value of the offer. Thus, the market value of Mark's offer is D, $402,537, rounded to the nearest dollar.